So I will briefly review the fifth question in the problem review set. So this is a case where a company is considering an investment in a new product. So after extensive research and development process, Baroto has recently developed a new tire. They named it Super Grip, and they're trying to decide whether they should make the investment necessary to produce and market the product. The tire is an ideal product for particular drivers who are driving a lot in wet weather and also engage in off-road driving. The R&D costs so far have been about $10 million. The Super Grip would be put on the market beginning this year, and the company expects it to stay on the market for a total of 4 years. The test marketing cost was about $5 million, and this has shown that there is a significant market for the Super Grip type tire. So as a financial analyst at the company, you've been asked by your CFO to evaluate the Super Grip project and provide a recommendation on whether to go ahead with this investment or not. Except for the initial investment that will occur immediately, we will assume that all of the cash flows will occur at the end of the year. So the company must invest initially about $200 million in production equipment to make the Super Grip. And this equipment can be sold for $50 million at the end of the 4 years. So far in terms of cost, R&D costs were about $10 million, test marketing costs about $5 million. If you go for the investment, $200 million is going to be invested in the initial equipment. And the equipment will have a $50 million salvage value or liquidation value, let's say. So the company intends to sell the Super Grip into two distinct markets. One of them is the original equipment manufacturer, meaning that they're going to sell directly to manufacturers like GM, Ford, and so on. The other one is the replacement market, where typical car drivers replace their existing tires for different reasons. So there are these two segments of the market. The OEM market is relatively small as compared to the other segment, but in this segment, the prices are expected to be $41 per tire. The variable cost to produce each tire is about $29. So the projected price in the OEM market is $41 per tire. Variable cost will be $29. In the country, $6.2 million automobile production is expected. And this market is expected to grow at a rate of 2.5%. The market share that the Baroto is targeting in this OEM market is about 11%. So for each automobile, obviously there are 4 tires that are needed. So you can think of the total market size roughly about 24 million tires. And the company will have a claim on, or at least give a shot at 11% of the market share. The replacement market is a little bit different. The retail prices are higher. So companies are going to be able to sell its tires at $62 per tire. Still the same cost, production cost would not vary. This market is a lot larger. 32 million tire sales are expected in that market. And the company will target an 8% share in this market. And this market is going to grow at a rate of 2%. The company plans to increase the price at 1% above the inflation. Given the demand elasticity analysis, they thought that they could push the price by 1% above inflation rate. In addition to the supergroup, the supergroup project will incur $43 million marketing and G&A costs for the first year. And this cost is expected to increase at the inflation rate in subsequent years. Company's tax rate is 40%. Annual inflation is expected to remain constant at 3.25%. So the price increase above inflation, as we indicated, is 1%. Variable cost increase, again, 1% above inflation. Marketing and general costs are $43 million. Tax rate is 40%. Inflation rate is 3.25%. The company uses a 14% risk-adjusted discount rate to evaluate its new product decisions. And the automobile industry analysts expect automobile manufacturers to produce 6.2 million, as we indicated, cars, and that market is going to grow at 2.5%. So the company's projected market share is 11%, as was indicated in the earlier data presentation. And similarly, 32 million tires are expected to be sold in the replacement market. 2% growth is expected, and the company's projected share in the market is 8%. The equipment that the company is going to invest in is expected to be depreciated at a 7-year MACRS depreciation schedule. So the immediate initial working capital requirement also for the company is going to be $9 million. And after that, it's going to be about 15% of the sales. So if the working capital requirement is anything larger than the $9 million in the forthcoming years, the incremental amount is going to be invested. So that should be incorporated into the cash flows. Now the question is, should this investment be pursued? So we will evaluate the project by using NPV and IRR methods. To put together the analysis, we need an estimate of the new investment requirement or initial outlay. We'll have to project the operational cash flows. Finally, we should figure out the terminal cash flow, and then use decision rules, IRR, NPV. Particularly for the NPV, we'll use a 14% discount rate. So here is a first shot at the data. The nominal price increases at 1% above inflation will amount to 4.28%, and here is how this 4.28% was calculated. So 3.25% inflation, 1% above inflation suggests that the growth should be about 4.28% in prices. We expect a similar increase in the variable costs. So year one market size is 6.2 million cars, and this is going to grow at a rate of 2.5% going forward. We are going to project for the next 4 years cash flows. Since each automobile has 4 tires in the OEM case, we will assume tires for automobiles sold is $24,800,000. And the super grips market share will be 11%. Therefore, they're going to be able to sell in the OEM market 2,728,000 tires. And then this stretches forward based on similar assumptions. Total tires needed in the OEM market, 11% share of the company, and so on. So the price to start with would be $41 per tire, but this is going to grow at a rate of 4.28% to the future. In the replacement market, we start with 32 million tires, which is going to grow at a rate of 2%. Company share is 8% of the market. Initial price is $62, which is going to grow at the 4.28% rate again. Variable cost to start with are $29, and it is going to grow at a rate of 4.28% forward. So variable cost times units that the company is going to be selling. So 2,728,000 plus 2,560,000 times 29 is going to give us the cost, variable cost in the operation. So we can separately calculate it and then aggregate it, or we could just simply multiply 29 with this, and we can get 275,568. So, I'm sorry, these are the, this top part is the revenues. These are 62,000 versus multiplied 2,560,000, and 41 multiplied by 2,728,000, which is going to bring the revenues, and then 29 is multiplied by, again, units to calculate the variable cost. So variable cost will be 153 million the first year, and then it's going to grow again at the rate of inflation plus 1%. So we could put together the operating cash flows by using the data that we have. So variable costs will be 153,352. We said marketing and G&A 43 million. Depreciation based on the projected investment and the MACRS depreciation scheme that we projected is going to be 28,580, 48,980, 34,980, and so on. So to start with, we would have $9 million net working capital, but in the subsequent years, the working capital requirement is 9% of the sales. So the second year, the required working capital investment is 40,585,000. We already had 9 million in place. The incremental investment is going to be the difference between 9 million and the initial requirement that we would have. So we will start with a 9 million investment. In order to be able to achieve 40,585,200, we will have to invest 31,585,200 additional. To get up to 43,257, we will have to invest again 2,672 from 4,585,200 to 43,257. And then to get up to 46 million, we have to invest another 2,848. In the terminal year, we will have 46,105,394 already accumulated net working capital investment. So the book value of the equipment to start with is 200 million, and this is actually the basis of the depreciation expenses that we projected in here. As we allocate depreciation, the book value drops, and finally, in the year of liquidation, book value is $62,480,000. The liquidation value is 50 million. Given the $62,480,000 of book value, we will incur a capital loss, and as a result, we will have a tax credit of 4,992,000. So this means that the liquidation value of the equipment is going to be 54,992,000. This is simply because we are selling it for 50 million, but since we are incurring a capital loss of about 12 million at the 40% tax rate. We get this tax credit. We consider that as a benefit. And the entire liquidation value is $54,992,000. So if you put together the operating cash flows based on all of these projections, so we have 55,961,600 for the first year, 67,864 in the second year, third, fourth. We have these figures in here. And capital spending is to start with $200 million investment. And then we will have this terminal value of 54,992 in the year 4. And our working capital investments to start with $9 million. So our initial investment is $209 million. In the subsequent years, the 55,961,600 are the operating cash flows, but subtracting net investment in working capital, this leaves us a free cash flow of $24,376,400. So operating cash flows, working capital adjustment, free cash flow of $65,192,203, and so on. So in the final year, we have, including the terminal cash inflow, $167,680.55 or $55 of free cash flow. In the next slide, we can execute the discounted cash flow analysis. So these are the stream of cash flows. Based on these stream of cash flows, NPV can be calculated as $4,639,698. IRR in this case is slightly above the 14% threshold, which is 14.83. So project is marginally profitable. It creates about $4.5 million, $4.6 million NPV. And profitability index, another indicator, is 1.02. So as long as this is about 1, we go for the investment. So evaluating the project with these parameters, we can think that the project looks slightly promising. But obviously, they're all, all of these projections are sensitive to pricing, market share assumptions. It is possible that we may not be able to increase the prices as we projected, or our market share might not develop the way we projected. So it would be wise just to conduct a sensitivity analysis and see how sensitive project NPV to these assumptions. So it will be always useful to simulate, maybe create a distribution to see what are the chances that we can actually end up with a positive net present value. So if under a lot of circumstances, if the project is generating a positive NPV, obviously it will be a go. So this is the crux of this case. Again, to emphasize a few things, we projected initially the operating cash flows and then made the net working capital adjustment, as we have seen in this line. The other important piece is the liquidation value. We used the $50 million liquidation value versus $62,480,000 projected book value that led to a capital loss, which brought in a tax credit, which increased the liquidation value or terminal value from $50 million to $54,992. In addition to the liquidation value that we had, we also included the recalling the net working capital in year 4. So in year 4, we estimated that we would have a total of $46,105,394 of working capital investment in place. and we assumed that we would recall the entire amount on liquidation. So that brought us to the total terminal cash flow for the final year of free cash flow, 167,680. So we hit pretty much all elements of the terminal cash flow. We have the operational cash flow in here. We have the value from liquidation, and also we have the recalling of the net working capital right in here. So this brings us to the neatly streamlined cash flows. And now this can be used to calculate the IRR or NPV, and then we decide based on that. And then we did the analysis, and 4.6 million turned out to be the NPV of the project. So this concludes this review, and I hope that the elements of the analysis are clear.